All right, let's just dive right into it. Welcome to the Masterclass. Today, we're unpacking the exact market structure and liquidity logic that is literally going to transform how you read the charts. Seriously, if you've been sitting there pulling your hair out, wondering why the market always seems to know exactly where you put your stops, well, this explainer is going to completely flip the script for you. I mean, we've all been there, right? You buy a breakout, it looks perfect, and then boom. It instantly reverses, snipes your stop loss, and then proceeds to go exactly where you predicted in the first place. So why does that happen? Why do your stop losses always seem to get hit right before the massive move? Look, the truth is, it isn't bad luck. The market is deliberately designed to hunt for resting capital. And that brings us to the core difference between two totally different mindsets. Think of retail pattern trading as basically volunteering to be the market's liquidity. You're being induced into these early traps. Liquidity logic, on the other hand, that's about waiting patiently for the trap to actually spring. You're basically letting all those other traders get hunted first. And then, only then, you step in to trade right alongside the true market momentum. So here is the game plan for today. We're breaking this down systematically. 1. The early trader trap. 2. Higher time frame narrative. 3. Finding engineered liquidity pools. 4. Our sniper entry model. And 5. Stop loss and target management. All right, section 1, the early trader trap. Let's look at how retail traders are induced. So let's talk about how the market actually communicates its intent to trap early money. The whole concept here revolves around the early trader trap. What this means is the market is making a deliberate move to get pattern traders to commit their capital way too early. When they do that, they unknowingly create this massive, juicy pool of resting stop losses that the market is absolutely going to sweep later. A sudden momentum push, or a fake breakout, those are specifically engineered to trick retail traders into going the exact wrong direction. But how exactly does it pull this off? Well, the market gives these early traders a false sense of security. It might throw out a fake break of structure momentum push, or it might temporarily hold a really obvious support or resistance zone. Heck, it might even paint a picture-perfect trend line. It's doing this to deliberately build a massive pool of liquidity right below or above those obvious patterns. Once everybody piles in thinking, oh, hey, I caught the breakout, the market snaps back, reverses hard, and just consumes all those stop losses. Moving right along to section 2, higher timeframe narrative. This is where we build our story. Listen, you absolutely cannot snipe these precise entries on a 1-minute chart if you don't know the broader story. You just can't. We have to use a macro to micro funnel. Step 1, go to the daily chart. Find your macro bias and your previous daily highs and lows before you even think about zooming in. Step 2, drop down to the 4-hour chart. This is where you locate exactly where those early trader liquidity pools are building up. And finally, step 3, that's when we drop down to the 15-minute, 5-minute, or 1-minute charts for the actual precise execution. Now here is a concept you absolutely have to master, the liquidity block, or LB for short. An LB is a very specific extreme price area that forms when a structural point is officially swept. Because all those stop losses have just been triggered and consumed, there is literally no liquidity left beyond that point. So that block becomes our impenetrable wall. Why? Because the market simply has zero financial incentive to ever trade past that level again. And please, whatever you do, remember this. A previous daily high or low means absolutely nothing on its own. Literally nothing. It only matters if it is directly paired with an underlying liquidity block. We are never out here blindly trading a previous daily high or low just because it looks like a nice pattern. We only take the trade if the market clearly communicates a liquidity block trap exactly at that extreme. Okay, section 3, finding engineered liquidity pools. Let's find those opposing targets. All right, so we've got our macro bias. Now we have to actually spot the traps. We're looking for what we call engineered liquidity. You're going to recognize this as a really choppy kind of no man's land range. The lows are respecting previous lows. The highs are respecting previous highs. This isn't just random market noise, guys. This is the active, deliberate engineering of opposing liquidity pools. The market is basically accumulating a massive amount of volume so that we can use it as our future profit target. And honestly, the sheer scale of this manipulation is just wild. Think about it. When those early traders are finally trapped, all that engineered liquidity that took 5 agonizing days to build up, it can get violently swallowed up in less than 18 hours. It's crazy. The market creeps up so slowly just to induce traders, and then bam, once it's time to run for that liquidity, It moves with explosive, relentless speed. Which brings us to Section 4, the sniper entry model. Time for mechanical execution. So the big question, how do we actually catch that explosive speed without guessing? Well, this is the climax of this whole explainer right here, the 4-candle model. This is a strict mechanical system that takes all the emotion right out of it. Check it out. Candle 1 prints a structural low. Okay, easy. Candle 2 sweeps that exact low, rejects it, and forms our liquidity block. Then Candle 3 comes down, but it respects its own low, which perfectly traps the early buyers. And finally, Candle 4 spikes right below Candle 3, triggers a limit order right at the optimal entry point, and then runs the other way. Now, you've got to be disciplined because the execution rules here are incredibly strict. First off, you have to wait for Candle 3 to print a higher low. Do not try to catch a falling knife by just jumping in blind. Let Candle 2 form your liquidity block, and then just wait. You place your limit order precisely below Candle 3, and this is crucial. You have to confirm that the underlying liquidity block is still perfectly intact. If it holds up, you just sit back, let Candle 4 spike down, and tag you in. And honestly, this is exactly how you stop being the hunted and finally become the hunter. If you're out there guessing the bottom, you are running a massive risk of becoming the market's liquidity yourself. But this 4-candle system, it forces you to wait for the sweep and just trade the reaction. You are patiently letting the trap spring first, which keeps your capital perfectly protected. And here is where it gets really fun, the stacking logic. If your higher time frame target hasn't been swept yet, every single false pullback is just another opportunity for you to stack an entry. Seriously, if you happen to miss the very first entry during the Asia session, don't panic. You can easily stack another entry during the New York session because that engineered target is still sitting up there, acting like a massive magnet for price. All right, final section. Section 5, stop loss and target management. Let's protect that capital. Because let's be real, entering perfectly means absolutely zero if you don't know how to manage your exits. So where exactly are we taking our profits once we're in the trade? The answer is beautifully simple. We do not use those arbitrary fixed risk-to-reward ratios. Instead, we mechanically target the exact opposing engineered liquidity pools that we found earlier in our higher time frame funnel. Now, depending on your personal trading style, you've got a couple of options here. Your first target option is intraday internal structural sweeps. Think like 15-minute highs. For those, your exit strategy is taking partial profits. Just lock some in. But your ultimate final target, that should be the higher time frame engineer's liquidity pool on the daily or the 4-hour chart. Your strategy there is a full volume exit. Guys, this is exactly how you capture those crazy 1 to 10 or 1 to 15 risk to reward trades. And your protection rules? Completely non-negotiable. Your stop loss goes universally outside the liquidity block, nowhere else. And listen to this. Never, ever roll your stop to break even until an opposing internal structure is officially swept. If you roll it to break even too early just because you're scared, the market is naturally going to retrace, tag you out, and then make that massive move you predicted totally without you. Look, if you take just one single thing away from this entire explainer, I want you to burn this rule right into your trading plan. We must only trade once the early traders are trapped. That's it. We never participate in that first impulsive move. We solely, patiently trade the devastating reaction that happens after the early capital is fully trapped. So I'll leave you with this final thought. Are you going to continue to be the hunted by blindly trading retail patterns? Or are you finally going to wait for the engineer trap and become the hunter? Starting today, I want you to analyze the charts backwards. Find out who just got trapped and let that be the roadmap to your next major trade. Thanks for hanging out with me on this explainer, and I'll catch you on the next one.